June's economic data was a cause for celebration on many levels, and it supported the narrative that the economy is strong. Let's look at some indicators and numbers that came out in June and then summarize them all together. We had the Dallas Fed Manufacturing Index, which turned out better than expected. We had the building permits for May, which is incredible as we had a 5.6% increase from previous month. We also had the durable goods, except of transportation, of course, for May, and we had the house price index, we had the new home sales. All of those were positive. Some of them are even double what it was the previous month. We also had consumer confidence for June, which even went higher than the month before despite all the recession narrative that was going on. And then we had the Fed shipment index for June as well, which was double the month before. All of that, we still see continuous jobless claims to be decreasing and initial jobless claims also decreasing. The one negative part here, which was kind of expected, is the corporate profits. That was from previous quarter. And that was, I think it was -6% compared to the previous -2.7%. Core PCE for May, year over year, came out as 4.6%. That's a slight decrease from 4.7% for April. While the GDP growth rate, that's the final revision for Q1, came out as 2%. Despite that, the second revision was 1.5%. That's an incredible discrepancy there, which make us kind of wonder if the data is correct. So on one hand, GDP came out much better than expected, yet it remains lower than previous quarter, which follows the slowdown narrative. Now, to summarize all this data, we can see here that the data proves that the economy is stronger than expected, as said, and it doesn't need stimulus from the Fed in the form of decreasing interest rate. That said, it remains slower than last year and will likely continue to be so, just not as slow as feared. While the elephant in the room here remains inflation. On that note, nothing wipes out inflation as much as a recession, but that's the very thing the Fed is avoiding by being tactical and closely monitoring macroeconomic data to chip away from inflation without triggering a jump in unemployment. A tedious task. Finally, it seems that the equity market has not priced in the 500 basis point rate increase yet. That is not surprising, knowing that this is usually a lagging effect, which will begin to appear as companies and businesses gradually need to raise cash, colliding with shrinking profitability, coupled with stubborn inflation. 10 years ago, raising $10 million using a 7-year maturity bond would cost about 2.5% in annual interest, or to put it in dollar terms, about $250,000. While raising the same amount for the same duration would cost 4.5% now, or $450,000 a year. Staggering difference.